The deadline for tax-saving investments for FY22 ends on the 31st of March. That leaves us with barely a couple of weeks for all those late risers, especially those doing it for the first time. But worry not, we've got you some tips to keep in mind. Number 1, make investments and important spends under Section 80C. Contributions of up to 1.5 lakh rupees in a given financial year to approved avenues, the likes of Employees Provident Fund (EPF), Public Provident Fund (PPF), Senior Citizen Savings Scheme, Life Insurance Premium, National Savings Certificate also called NSCs, tuition fees, Sukanya Samriddhi Yojana, NPS, ELSS and even home loan principal repayment are deductions from the income of an individual. Though there are too many competing avenues, a careful look at them can help you plan your taxes better. As there's not much time at hand, you may want to quickly close this chapter. If you're earning a salary, you may already be contributing to EPF. You could also be paying children's tuition fees or a life insurance premium. If you have a home loan running, ask for the provisional statement of loan repayment for the year from your housing finance company to get an idea of how much money you have already invested in permissible avenues under Section 80C of the Income Tax Act. If there's a shortfall, you can then invest accordingly. So if there is a shortfall indeed, you should first look at your existing commitments. These include PPF and Sukanya Samriddhi Yojana accounts opened in earlier years. You should be contributing at least the minimum amount of 500 and 250 rupees respectively to these if they are catering to your financial goals, say retirement planning or a child's higher education. You should contribute these in line with the permissible limit of 1.5 lakh rupees per year. Payment of renewal premium of existing life insurance policies also fetches you a tax break. If you do not have existing commitments, the ones that I just mentioned, you need to identify your financial needs and invest accordingly. Conservative investors can consider NSCs, and in case of senior citizens, SCSS is better if you're not already invested there. For aggressive investors, ELSS or tax-saving funds as they're popularly known make sense. Among Section 80C investments, ELSS has the shortest lock-in of 3 years and has the potential to offer high returns. But since it invests in shares, it may not suit all kinds of investors, especially the conservative lot. So if you have exhausted Section 80C, look at Section 80CCD1B that offers additional 50,000 rupees tax deduction if you invest money in NPS. This is of course over and above the tax deduction availed under Section 80C. If you do not have life insurance cover, you can buy a term life insurance policy after taking into account your insurance needs as well. Don't forget to buy insurance. Payment of premium up to 25,000 rupees towards health insurance for yourself, your spouse and children can be claimed under Section 80D. If you're buying health insurance for your parents, an additional 25,000 rupees can be claimed in a year. In case the insured persons are senior citizens, double that amount, that is 50,000 rupees for self and family, and parents totaling 1 lakh rupees per year can be claimed. Many individuals rely on employer-provided health insurance, and such cover ceases to exist when they switch jobs. Hence, it makes sense to buy health insurance for your family and for yourself. Also, if you have undergone a preventive medical checkup in the current financial year, you can claim expenses of up to 5,000 rupees under Section 80D. Some more points to keep in mind. Do not wait till the last few days of the month. If your check does not get credited before the year ends, the investment will not be considered for the current financial year. And if you have invested in an ELSS earlier, check the performance. Even if it is an average performer, you can add to it. You need not invest in last year's winner. If you do not have funds to invest in this financial year, look at your past investments for some help. For example, if you have some old ELSS units which are out of lock-in, then they can be sold and the proceeds invested again in the same scheme to claim deduction. And finally, after you're done with this year's tax planning, make a plan for next year and implement it as soon as possible.